Hello and welcome back to Intelligent Investment Today. This is the podcast where we explore the principles behind long-term wealth creation, not only in the markets, but in the everyday financial decisions that shape our lives. In this episode, we're going to focus on a practical investing concept, one that is widely used, often misunderstood, and particularly relevant for long-term investors. Dollar cost averaging. It is not a complex strategy. It does not rely on forecasting the markets. It does not require precise timing. And yet, when applied consistently, it can be a powerful tool for building wealth over the long term. Today we'll explore what dollar cost averaging is, why it works, where its limitations lie, and how it fits within a disciplined, value-orientated investment approach. So sit back, tune in, and get ready to take on board another lesson in value investing, as inspired by Benjamin Graham. So let's start with the basics. Dollar cost averaging is the process of investing a fixed amount of money at regular intervals, regardless of market conditions. That might mean investing monthly or weekly, or whenever income is received. The key idea is consistency. You invest the same amount repeatedly over time. Now, on the surface, this may seem almost too simple. Why not wait for the right moment? Why not invest when markets are low and avoid investing when they are high? In theory, that sounds logical. But in practice, it is extremely difficult because identifying market highs and lows in real time is not straightforward. It requires judgment, forecasting, and more often than not, a degree of luck. Dollar cost averaging removes that requirement. It replaces timing with process. It changes something reactive into something systematic. To understand why dollar cost averaging works, it helps to consider what happens during different market conditions. When prices are high, your fixed investment buys fewer shares. When prices are low, the same amount buys more shares. Over time, this results in an average purchase price that reflects a range of market conditions. You're not trying to buy at the absolute bottom, nor are you avoiding purchasing at the top. Instead, you're participating consistently, allowing price fluctuations to work in your favour over time. This is sometimes referred to as smoothing your entry into the market, and psychologically, it can be very powerful. This is because it reduces pressure to make a single high-stakes decision. You are not asking, is now the perfect time to invest? You are simply following a plan. Now, one of the greatest challenges investors face is not technical. It is emotional. Fear when markets fall, euphoria when they rise. The temptation to act, to change course, to try and outguess the market. Dollar cost averaging helps to manage this because it introduces discipline. It creates a structure that operates independently of emotion. When markets decline, the instinct is often to wait, to hold back, to avoid further losses. But under the dollar cost averaging approach, those moments become opportunities to acquire more shares at lower prices. And this is where behaviour begins to align with long-term investing principles. You are, in effect, buying more when prices are less attractive to others, which echoes one of the core ideas of value investing. Now, this does not mean that dollar cost averaging is a perfect strategy. It has its limitations, and it's important to understand them. One key point is this. If you have a large sum of money available to invest today, dollar cost averaging may not always produce the highest return. Markets over long periods tend to rise, which means that investing earlier in a lump sum often leads to better outcomes because more of your capital is exposed to growth for a longer period. So from a purely mathematical perspective, lump sum investing can have an advantage. But that is only part of the story, because real-world investing is not purely mathematical. It involves human behaviour, and behaviour can significantly affect outcomes. If investing a large sum all at once causes anxiety, if it leads to second-guessing, if it results in pulling money out during downturns, then the theoretical advantage can quickly disappear. In contrast, dollar cost averaging can make the process more manageable, more consistent, and more sustainable over time. So while it may not always maximise returns in theory, it can improve outcomes in practice. There is also an important connection between dollar cost averaging and regular income. For many investors, capital is not available all at once. It is earned gradually, through salaries or business income. And in that context, dollar cost averaging is not just a strategy. It is a natural consequence of how money is received. You invest as you earn, month by month, year by year. And over time, those contributions accumulate. This is where the real power of the approach becomes evident. Because when combined with compounding, consistent investment can lead to significant long-term growth. Each contribution adds to the base. Each return builds on the last. And gradually the process accelerates. But this requires patience, because the early stages can feel slow, and the progress may not be immediately visible. And this is where many investors lose discipline. They stop, they interrupt the process, they try to optimise. But the strength of dollar cost averaging lies in its consistency, not its complexity. Now let's consider how this fits within a value investing framework. At first glance, there may appear to be a tension. Value investing often involves waiting, holding cash, deploying capital when opportunities arise. Whereas dollar cost averaging involves continuous investment, regardless of the price. So how do the two align? The answer lies in perspective. Dollar cost averaging does not replace valuation, it complements it. For broad long-term investing, particularly in diversified portfolios, dollar cost averaging provides a disciplined way to build exposure. It ensures that you are consistently participating in the market. But within that framework, valuation still matters. You can adjust allocations, tilt towards areas that appear more attractive, or hold additional cash when opportunities are limited. In other words, dollar cost averaging provides a structure, while value investing provides the judgment. And together they can form a balanced approach. Another important benefit of dollar cost averaging is that it removes the need for prediction. Markets are influenced by a wide range of factors: economic data, interest rates, geopolitical events, investor sentiment. Trying to forecast all of these with precision is extremely difficult. And often, attempts to do so can lead to overconfidence or inconsistency. But dollar cost averaging sidesteps this challenge. It accepts uncertainty. It acknowledges that the markets cannot be perfectly timed, and it focuses instead on participation. This does not mean ignoring risk. It means recognising the limits of prediction and building a process that works despite those limits. There is also a subtle but important shift in mindset that comes with dollar cost averaging. It moves the focus away from short-term outcomes and towards long-term behaviour. Instead of asking, "Did I invest at the right time?" The question becomes, am I following my process? Am I consistent? Am I building over time? And this shift can reduce stress, because success is no longer tied to individual decisions, but to the overall discipline of the approach. Of course, like any strategy, dollar cost averaging requires commitment. It works best when applied consistently, over long periods, through different market conditions. This includes bull markets where prices are rising, bear markets when prices are falling, and everything in between. Interrupting the process, stopping during downturns for example, can reduce its effectiveness, because those periods often provide the most attractive entry points. So the challenge is not understanding the strategy, it is maintaining the discipline to follow it. And that brings us back to one of the central themes of value investing, behaviour. Because in the end, the success of any strategy depends not just on logic, but on the ability of the investor to stick with it. To conclude, dollar cost averaging is not about finding the perfect moment to invest. It is about removing the need to find it. It replaces timing with consistency, prediction with process, and reaction with discipline. It may not always produce the highest theoretical return, but it can provide something equally valuable: clarity, structure, and a sustainable path to long-term investing. And for many investors, that is exactly what is needed. That brings us to the end of today's edition of Intelligent Investment Today. A straightforward concept, but one with meaningful implications for how investing is approached over time. Consistency, discipline, and patience. These are often more important than precise timing of the market. And dollar cost averaging is one way to put those principles into practice. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.